Hello everyone. Today we will be talking about the SMEs definition. But before we dive right into it, let me first show you the 35 sections comprising the PFRS for SMEs relating to topics basically on financial accounting and advanced accounting. So here are the 35 sections. So the Financial Reporting Standards Council, or FRSC, approved on October 13, 2009, the adoption of IFRS for SMEs, issued by the International Accounting Standards Board, or IASB, as Philippine Financial Reporting Standards for Small and Medium-Sized Entities, or PFRS for SMEs. The Philippine Securities and Exchange Commission and Bank, in its meeting on December 3, 2009, also resolved to adopt the PFRS for SMEs as part of its rules and regulations. Now let's proceed to the definition of SMEs. So the International Accounting Standards Board defines small and medium-sized entities, or SMEs, as entities that do not have public accountability and publish general-purpose financial statements for external users. An entity has public accountability if its debt or equity instruments are traded in a public market. Second, it is in the process of issuing debt or equity instruments for trading in public market, for example, domestic or foreign stock exchange, over-the-counter market, local and regional market. And C, it holds assets in fiduciary capacity for a broad group of outsiders as one of its primary businesses. So, banks, credit unions, insurance companies, securities dealers or brokers, pension funds, mutual funds, and investment banks would meet this second criterion. Now to our securities traded in a public market. So the IASB concluded that regardless of size, entities whose securities are traded in a public market should follow full IFRS and not IFRS for SMEs. An entity's decision to enter a public capital market makes it publicly accountable. Next are the financial institutions. So the primary business for financial institutions is to hold and manage financial resources entrusted to them by a broad group of clients and customers who are not involved in the management of the entities. Accordingly, financial institutions must follow full IFRS and not IFRS for SMEs. Now to our SME under Philippine jurisdiction. Under Philippine jurisdiction, the definition of small and medium-sized entity, or the SME, includes size, criteria in terms of total assets and total liabilities. The definition of SME is set forth in Philippine Securities and Exchange Commission and Bank Resolution dated August 13, 2009. Let us proceed to the definition of SME by the SEC. The Philippine Securities and Exchange Commission defines SME as an entity, first, with total assets between 3 million and 350 million, or with total liabilities between 3 million and 250 million. Second, that is not required to file financial statements under SRC Rule 68.1. So what is the Rule 68.1? Pertains to listed entities or entities whose securities are traded in an exchange market, and entities which assets of at least 50 million and have 200 or more holders, each holding at least 100 shares of a class of equity securities. Next is, that is not in the process of filing financial statements for the purpose of issuing any class of instruments in a public market. D, that is not a holder of secondary license issued by a regulatory agency such as a bank, so all types of banks are involved, an investment house, a finance company, an insurance company, securities broker or dealer, a mutual fund and pre-need company. And lastly, that is not a public utility. Now, what are microbusiness entities? Microbusiness entities are entities whose total assets or total liabilities are below the 3 million floor threshold. Microbusiness entities have the option to use any of the following bases of accounting in the preparation of financial statements: the full PFRS, PFRS for SMEs, and another acceptable basis of accounting. Now here presents the exemptions from PFRS for SMEs. So we have it is a subsidiary of a parent reporting under full PFRS. So again, these are the exemptions from PFRS for SMEs. And second, it is a subsidiary of a foreign parent that will be moving toward full IFRS pursuant to the foreign country's published convergence plan. Third, it is a subsidiary of a foreign parent that has been applying the standards for a non-publicly accountable entity for local reporting purposes, and so on. And the fourth is that it has a short-term projections that show that it will breach the quantitative thresholds set in the criteria for an SME, and so on. And fifth, it is a part of a group, and so on. It is a branch office of a foreign entity reporting under full IFRS. It has concrete plans to conduct an initial public offering within the next 2 years. 8. It has a subsidiary that is mandated to report under full PFRS. And lastly, it has been preparing financial statements using full PFRS and has decided to liquidate its assets. Next is the first-time adopter. So what is a first-time adopter? A first-time adopter of IFRS for SMEs is an entity that presents the first annual financial statements that conform with IFRS for SMEs, regardless of whether the previous accounting framework was full IFRS or another set of generally accepted accounting principles. Now, the date of transition. The date of transition to IFRS for SMEs is the beginning of the earliest period for which full comparative information is presented in accordance with IFRS for SMEs in the first annual financial statements that conform with IFRS for SMEs. Thus, if the first-time adopter presents the first annual financial statements in conformity with IFRS for SMEs on December 31, 2020 on a comparative basis, the date of transition to IFRS for SMEs is January 1, 2019. Under Philippine jurisdiction, the PFRS for SMEs is effective for annual periods beginning on or after January 1, 2010. Now to the transition from PFRS for SMEs to full PFRS. If an SME that uses the PFRS for SMEs in a current year breaches the floor and ceiling size criteria at the end of the current year, the entity shall be required to transition to full PFRS in the next year if the ceiling threshold is breached, or another acceptable accounting basis if the floor threshold is breached. This transition must be made provided the event that caused the change is considered significant and continuing. As a general rule, 20% or more of total assets or total liabilities would be considered significant. Next is the opening statement of financial position is a statement of financial position at the date of transition to PFRS for SMEs. In the opening statement of financial position, a first-time adopter shall recognize all assets and liabilities whose recognition is required by PFRS for SMEs, not recognized as assets or liabilities if the PFRS for SMEs does not permit such recognition. C. Reclassify items that is recognized under the previous accounting framework as one type of asset, liability, or component of equity, but a different type of asset, liability, or equity under PFRS for SMEs. D. Is apply PFRS for SMEs in measuring all recognized assets and liabilities. Note that First-time adoption requires full retrospective application of PFRS for SMEs, effective at the reporting date for an entity's first annual financial statements that conform with PFRS for SMEs. Now here are the mandatory exceptions to retrospective application: the recognition of financial assets and financial liabilities, hedge accounting, accounting estimates, discontinued operations, measuring non-controlling interest. In general, no restatement of the opening statement of financial position is required if it is impracticable to do so. Impracticability means the entity cannot apply your statement after making every reasonable effort to do so. Now to our reconciliation. Here are the reconciliations that a first-time adopter shall make in the financial statement. So we have reconciliation of equity reported under the previous reporting framework to equity under PFRS for SMEs for both the transition date and the end of the latest period presented in the entity's most recent annual financial statements, and the reconciliation of the profit or loss determined in accordance with the previous reporting framework, and so on. Now we are done with defining our SMEs. Now let us proceed to the SMEs financial statements. Now here are the general features of financial statements. So first is the fair presentation and compliance with PFRS for SMEs, going concern, accrual basis, materiality and aggregation, offsetting, frequency of reporting, comparative information, and the consistency of presentation. Full PFRS and PFRS for SMEs have the same provisions on the general features in the preparation of financial statements. Now let us first define fair presentation. So virtually in all circumstances, fair presentation is achieved in the financial statements of an SME are prepared in accordance with the PFRS for SMEs. Next is the compliance with PFRS for SMEs. So an entity whose financial statements comply with PFRS for SMEs shall make an explicit and unreserved statement of such compliance in the notes. However, a publicly accountable entity is prohibited from making this statement of compliance, even if it is required by law to prepare the financial statements in accordance with the PFRS for SMEs. Now, the second one is going concern. Going concern means that the accounting entity is viewed as continuing in operation indefinitely in the absence of evidence to the contrary. Now next is the accrual basis. Accrual accounting means that income is recognized when earned regardless of when received, and expense is recognized when incurred regardless of when paid. Materiality and aggregation. So an entity shall present separately each material class of similar items. An entity shall present separately items of dissimilar nature or function unless they are immaterial. Now next is the offsetting. Assets and liabilities and income and expenses, when material, shall not be offset against each other. So offsetting may be done when it is required or permitted by another PFRS. Now, next is the frequency of reporting. An entity shall present a complete set of financial statements at least annually. So, when an entity changes the end of the reporting period and presents financial statements for a period longer or shorter than 1 year, an entity shall disclose we have 3. The period covered by the financial statements, the reason for using a longer or shorter period, and lastly, the fact that amounts presented in the financial statements are not entirely comparable. Next is comparable information. So, except when permitted or required otherwise by PFRS for SMEs, an entity shall disclose comparative information in respect of the previous period for all amounts reported in the current period's financial statements, including narrative and descriptive information. Now, consistency of presentation. The principle of consistency requires that the accounting methods and practices shall be applied on a uniform basis from period to period. The presentation and classification of financial statement items shall be uniform from one accounting period to the next. Now let us discuss the components of financial statements. So here are the components of financial statements. First is the statement of financial position, so either a single statement of comprehensive income or a separate income statement and a separate statement of comprehensive income. Third is the statement of changes in equity, statement of cash flows, and the notes. However, a single statement of income and retained earnings can be presented by an SME. Instead of a statement of comprehensive income, a statement of changes in equity if the only changes to the equity are the result of the following: the profit or loss. Second is the payment of dividends. Third is the prior period errors. Fourth is the changes in accounting policy. So in these cases, an SME is permitted but not required to present a single statement of income and retained earnings. So in addition to that, the components of financial statements of an SME are similar to those provided by full PFRS. However, a single statement of income and retained earnings is not permitted. Again, it's not permitted under full PFRS. A statement of changes in equity is always required. Now, let us compare the statement of financial position of what must be presented under full PFRS and the PFRS for SMEs. So, when it comes to the statement of financial position under the full PFRS, the ones that will be presented are the total of assets classified as held for sale. Second is the total of liabilities included in disposal group classified as held for sale, and the investments in associates. So, under the PFRS for SMEs, we have the investments in associates. Second is the investment in joint ventures. So, under the PFRS for SMEs, they should include as amended to include a separate line item investment property carried at cost less accumulated depreciation and impairment. And D is the current and non-current assets, and E is the current and non-current liabilities. So, full PFRS and PFRS for SMEs have the same provision on the current and non-current separate presentation. Full PFRS and PFRS for SMEs have the same definition of current assets, non-current assets, current liabilities, and the non-current liabilities. Now, let's proceed to the comprehensive income. So, comprehensive income is the change in equity during a period resulting from transactions and other events other than changes resulting from transactions with owners in their capacity as owners. So, in other words, comprehensive income includes the following. It is the components of profit or loss and the components of other comprehensive income. So, profit or loss. The term profit or loss is the total of income less expenses, excluding the components of other comprehensive income. In other words, this is the bottom line in the traditional income statement. An entity may use net income or net loss to describe profit or loss. So, under PFRS for SMEs, the components of other comprehensive income are gain or loss from translating the financial statements of a foreign operation. Second is the actuarial gain or loss on defined benefit plan. So under PFRS for SMEs, the SME has a policy choice whether to present this item as component of other comprehensive income or component of profit or loss. Third is the change in fair value of a hedging instrument that was effective in offsetting the change in the fair value or expected cash flows of the hedge item. Now, fourth is the revaluation surplus from the revaluation of property, plant, and equipment as allowed now under the amended paragraph 17.15 of PFRS for SMEs. Now, let's proceed to the full PFRS. So, the components of the other comprehensive income in the full PFRS are the gain or loss from translation of the financial statements of a foreign operation, remeasurements of defined benefit plan, unrealized gain or loss from derivative contracts designated as cash flow hedge, unrealized gain or loss on equity investment measured at fair value through other comprehensive income, and unrealized gain or loss on debt investment measured at fair value through other comprehensive income. 6 is the revaluation surplus during the year. 7th is the change in fair value attributable to credit risk of a financial liability designated at fair value through profit or loss. Now let us proceed to the presentation of the other comprehensive income, or the OCI. Let us first talk about the PFRS for SMEs. So here we have OCI that will be reclassified to retained earnings. So we have gain or loss from translating the financial statements of a foreign corporation. Second is the actuarial gain or loss in defined benefit plan if the entity elected to present such item in OCI. Third is the revaluation surplus during the year related to revaluation of property, plant, and equipment. And second is the OCI that will be reclassified to profit or loss includes change in fair value of hedging instruments. So let's proceed to the presentation of OCI under the full PFRS. So we have here the gain or loss from translating financial statements of a foreign operation, unrealized gain or loss on derivative contracts designated as cash flow hedge, and the unrealized gain or loss on debt investment measured at fair value through OCI. So here are the line items for OCI that will be reclassified subsequently to retained earnings. So here are the following. So first is the remeasurements of defined benefit plan, including actuarial gain or loss on projected benefit obligation. Second is the unrealized gain or loss on equity investment measured at fair value through OCI, the change in revaluation surplus, and the change in the fair value attributable to credit risk of financial liability designated at fair value through profit or loss. Now to our statement presentation. So full PFRS and PFRS for SMEs have the same provisions on the presentation of the following: a statement of comprehensive income, the statement of changes in equity, and the statement of cash flows. Now let's proceed to the notes to financial statements. Notes to financial statements provide narrative description of this aggregation of items presented in the financial statements and information about items that do not qualify for recognition. The entity shall cross-reference each item in the financial statements to any related information in the notes. So we have here the structure of the notes. So the notes to financial statements shall present information about the basis of preparation of the financial statements and the accounting policies applied, disclose the information required by the PFRS for SMEs that is not presented elsewhere in the financial statements, and lastly is to provide information that is not presented elsewhere in the financial statements but relevant to an understanding of the information. Now here is the order of presenting the notes. So the statement of compliance with PFRS for SMEs, the summary of significant accounting policies applied, the supporting information for items, and any other disclosures. So the PFRS for SMEs and full PFRS are the same in the matter of presenting the notes to financial statements. However, the PFRS for SMEs does not require the presentation and disclosure of the following. First is the segment information, earnings per share, and the interim financial reports. Let us proceed to the related and unrelated parties. So here are the major categories of related parties. The affiliates, they are the parent subsidiaries, and fellow subsidiaries. Associates include the subsidiary or the subsidiaries of the associates. Joint ventures include the subsidiary of subsidiaries of joint ventures. And We have the key management personnel of the entity. We have the close family members of the key management personnel, individuals with significant influence over the reporting entity and close family members of such individuals. We have the post-employment benefit plans. So here are the major categories of unrelated parties. So two entities simply because they have a director or other key management personnel in common. Two ventures simply because they share joint control over the joint venture. C. We have the providers of finance, trade unions, public utilities, and government agencies simply by virtue of their normal dealings with the reporting entity. And lastly is a customer, supplier, franchisor, distributor, or general agent with whom the reporting entity transacts a significant volume of business merely by virtue of the resulting economic dependence. The PFRS for SMEs and full PFRS share the same principles with respect to related party disclosures. So the disclosure of related party transactions is the amount of the transaction, the amount of outstanding balances, the terms and conditions, whether secured or unsecured, and nature of consideration to be provided in settlement. C is the allowance for doubtful accounts related to the outstanding balances and the expense recognized during the period in respect of doubtful accounts due from related parties. Now let us proceed to the events after the end of reporting period. Events after the end of reporting period are those events favorable and unfavorable that occur between the end of reporting period and the date when the financial statements are authorized for issue. So we must know that there are two types of events after the end of reporting period, namely the adjusting events and non-adjusting events. So the adjusting events are those that provide evidence of conditions that existed at the end of reporting period and lead to adjustments of the financial statements. And non-adjusting events are those that are indicative of the conditions that arose after the end of reporting period and do not lead to adjustments, but only to disclosures in the financial statements. So the PFRS for SMEs and full PFRS share the same provisions for accounting and reporting events after the end of reporting period. Now let us proceed to the accounting changes. So PFRS for SMEs and full PFRS have the same provisions and requirements with respect to the following: the selection of accounting policies, the consistency of accounting policies, changes in accounting policies, changes in accounting estimates, and the correction of prior period error. So let us proceed to the selection of accounting policies. Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. If the PFRS for SME specifically addresses a transaction, other event, or condition, the SME shall apply the PFRS for SMEs. So if the PFRS for SMEs does not specifically address a transaction, other event, or condition, management shall use its judgment in developing and applying an accounting policy that results in information that is relevant and reliable. So for SMEs, here are the guidance. These are the things that the management shall consider the following sources in descending order. And under the full PFRS, here are that the management may consider. So the management may consider the following. Now, the consistency of accounting policy. An SME shall select and apply the accounting policies consistently for similar transactions unless the PFRS for SMEs requires or permits otherwise. So, the change in accounting policy, so we have here a change in accounting policy shall be made only when required by PFRS for SMEs, and the change will result in more relevant and faithfully represented financial information. So, what is the treatment of change in accounting policy? The treatment will be, a change in accounting policy as a result of an amendment to the PFRS for SMEs is accounted for in accordance with the transitional provisions therein. If there is no transitional provision, or if an accounting policy is changed voluntarily, the change is applied retrospectively. So, let us proceed to the change in accounting estimate. So, a change in accounting estimate in a normal recurring correction or adjustment, which is a natural result of the use estimate. Changes in accounting estimate result from new information or new development and accordingly are not corrections of errors. When it is difficult to distinguish a change in accounting policy from a change in an accounting estimate, the change is treated as a change in an accounting estimate. So, the treatment of change in accounting estimate, the effect of change in accounting estimate is recognized prospectively by including it in profit or loss of the period of change if the change affects that period only, and the period of change in future periods if the change affects both. And lastly, the prior period errors. Prior period errors or omissions and misstatements in the financial statements for one or more periods arising from a failure to use or misuse of reliable information that was available when financial statements for those periods were authorized for issue could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. So, take note that errors may occur as a result of mathematical mistakes, mistakes in applying accounting policies, and misinterpretation of facts and fraud or oversight. Prior period errors are adjusted retrospectively by adjusting the opening balance of retained earnings and affected assets and liabilities. If comparative statements are presented, the financial statements of the prior period shall be restated so as to reflect the retroactive application of the prior period error. So this is known as retrospective restatements. So that would be the end of my report, and good day everyone, and again, have a nice day. Thank you for listening.